The global economy is facing challenges due to monetary issues like the escalating debt costs and the recent stock market crash. As investors and consumers, what actions should we consider taking? Renowned American attorney, economist, investment banker, media analyst, and author Jim Rickards offers valuable insights and safety measures in this video. Jim not only explains his perspective on the impending crisis, but also provides practical tips for preparation, accompanied by historical context. Why should you lend an ear to Jim Rickards' predictions? Well, he brings a wealth of experience, having played a key role in corporate bailouts, notably negotiating a successful $3.6 billion rescue in 1998 while serving as the General Counsel for Long-Term Capital Management, LTCM. His foresight is evident in his early recognition of issues, such as his skepticism towards Kevin O'Leary's comments on the FTX crash, as conveyed in a tweet on November 15, 2022. Rickards has been a consistent voice cautioning against cryptocurrency risks, dating back to 2017 when he labeled it as crypto hysteria. His predictions extend to the belief that governments and global elites will eventually undermine and manipulate the sector for their dominance and control. This skepticism is rooted in Rickards' comprehensive understanding of financial dynamics, making his insights worth considering in navigating the evolving economic landscape.
Capitalists control the means of production, so they extract excess value from labor. Labor doesn't get their fair share. All of that's nonsense in terms of how we value things. But the point is, subjective value is based on confidence. It's a liquidity preference. If you're willing to transfer your hard-earned dollars to get a Bitcoin, you're expressing a liquidity preference for a different form of money. But confidence is fragile. Again, if you're throwing your wealth into Bitcoin and that confidence is lost, what's left?
In his best-selling 2019 book, Aftermath, Jim Rickards exposes the artificial inflation of global markets and offers insights on how readers can prudently safeguard their capital. Rickards presciently warns about various asset sectors, notably cryptocurrencies. In a March 1, 2021, article for the Daily Reckoning, he boldly asserts that Bitcoin is built on fraud and is destined for collapse. Referring to the Bitcoin fall of 2018 as a precursor to a more significant crash, Rickards predicts that cryptocurrency investors will eventually face bankruptcy. Recent events seem to validate Rickards' concerns. The world's fifth largest cryptocurrency exchange, FTX, abruptly shut down, causing a ripple effect across the entire sector. Reuters reports that a substantial amount, at least $1 billion, belonging to FTX clients has gone missing. According to Rickards, the entire FTX business appears to have been a massive Ponzi scheme rooted in deception. He draws parallels between FTX's downfall and the infamous Enron or Bernie Madoff scams, suggesting that FTX's scope and magnitude might surpass both. This underscores Rickards' earlier warnings about the precarious nature of the cryptocurrency landscape.
Personally, I'm very skeptical of Bitcoin. I know what the price action is. It's going up, but 10% a day at this point. Look, Bitcoin could go to 20,000. It could go to 30,000. It's on its way to zero, somewhere between 0 and 200. It's a utility token for criminals, terrorists, money launderers, tax evaders. They'll always find some use for it, so it may not go all the way to zero.
Jim Rickards has consistently emphasized the significance of gold and its dual role as both a store of wealth and a strategic asset. In his 2009 speech at Johns Hopkins University and subsequent best-selling books, Rickards delves into the value of gold as a safeguard against political volatility and market unpredictability. His debut book, Currency Warfare, 2011, specifically highlights the risks associated with covert Chinese gold acquisitions and currency manipulation. In his 2016 book, The New Case for Gold, which became a USA Today and Wall Street Journal business bestseller, Rickards reinforces the enduring importance of gold. He contends that gold serves as a benchmark for currencies, offering stability amid global economic uncertainties. Rickards also suggests that global elites are accumulating gold assets in anticipation of an impending financial crisis, a viewpoint echoed in his 2016 work, The Road to Ruin. In a tweet dated November 1, 2022, Rickards reflects on the accuracy of his predictions, noting that central banks are currently acquiring gold at unprecedented levels. He speculates that this heightened interest in gold may indicate awareness among these institutions of potential financial challenges that others may be overlooking. Rickards expresses skepticism about the Biden administration's foreign policies and suggests that President Biden's inclination toward Armageddon might be a contributing factor to the current state of affairs. Rickards is vocal about his concerns, particularly criticizing the Biden administration's foreign policies and perceived dishonesty in a tweet from October 19, 2022. His skepticism extends to alliances with countries like Saudi Arabia, as discussed in his 2014 New York Times bestseller, The Death of Money. In this book, Rickards anticipates the current deadlock in global politics, tensions with China and Russia, and warns against excessive reliance on Middle Eastern oil producers. His foresight extends to predicting potential economic chaos and financial conflicts stemming from such dependencies.
The collapse of sterling and the collapse of budget is part of a global monetary contraction pending global financial crisis having to do with the dollar shortage. You look around markets around the world, UK, but sure, US, elsewhere in Europe, this is what's going on. Stocks are down, bonds are down, gold is down, oil is down. The euro is down relative to the dollar, sterling's down, etc. You look around.
Looking around in 2024, we find ourselves depleting our strategic oil reserves without putting much effort into achieving energy independence. The Federal Reserve, Fed, is currently facing significant pressure, with recent official data indicating that the employment market is still hotter than the Fed would prefer. Despite these facts, the Fed cannot justify a change of course. However, the rapid and abrupt rise in interest rates orchestrated by the Fed is beginning to have adverse effects, as evidenced by a recent spate of bank failures. This situation may compel the Fed to reconsider its strategy. In coping with the tight situation, the Fed can take action to combat demand pull inflation by increasing interest rates on various financial products. Unfortunately, the Fed is powerless to address supply chain or cost-push inflation, as obtaining essential materials like titanium from Russia for gold production or ensuring the smooth functioning of supply systems presents challenges. As a result, bond prices are rising, and different types of inflation are putting pressure on costs. Demand pull inflation, where customers alter their behavior in response to rising prices, is becoming evident. People are inclined to make purchases sooner, anticipating significant price hikes in the next 3 months for items such as dishwashers, vehicles, and refrigerators, adapting to the perception that waiting will result in considerably higher prices. In this scenario, even if prices rise, there may still be enough money for essential expenses, like putting petrol in your car and buying food. However, discretionary spending would likely decrease, as the cost of these crucial items has already increased. People might opt to skip trips, concerts, restaurants, and refrain from purchasing new furniture, adopting a more frugal lifestyle to prioritize spending on necessities like food and petrol. Despite the Federal Reserve's willingness to raise interest rates to combat inflation, such actions could have adverse effects, potentially chilling the job market and even pushing the economy into a recession. It's important to grasp the message being conveyed by bond markets. A noteworthy signal is the sale of 2-year Treasury bond holdings by investors, resulting in the yield surpassing 5% for the first time since 2007.
Well, we'll look back and say that these interest rate increases, and by the way, we've had 3 75 basis point hikes in a row, June, July, and September, and maybe more on the way, maybe another one in November. That is tightening money. It's tightening money at exactly the wrong time. They should back off on that. The central banks are kind of irrelevant. The Bank of England has blundered with this gilts purchase. They made the classic mistake but you're right about but what I was describing, where I disagree slightly, Liam, what I was describing is independent of the interest rate hikes. Now those are tightening at the wrong time. That's a blunder.
Jim Rickards expresses deep concern over the current state of margin debt levels, which have surged to twice the levels seen before the 2008 financial crisis. This heightened level of excessive debt, particularly in the stock market, where approximately $1 trillion are borrowed, raises alarm bells. Rickards notes that this borrowed money has increased significantly, especially during the trade war. Anticipating a potential market fall, Rickards suggests that if it occurs, it could be one of history's swiftest and most severe corrections. Unlike previous rebounds seen after the 2008 financial crisis or the coronavirus crash, he envisions a scenario where the stock market might remain down for years, possibly even decades. Despite the substantial amount of money the Federal Reserve, Fed, has injected into the American financial system, Rickards points out that until last year, there wasn't the kind of tremendous inflation currently being experienced. He contrasts this with a period since the 1990s when inflation was on a downward trajectory, averaging about 2%. To prepare for a potential backlash, Rickards recommends specific steps for investors. One notable suggestion is to allocate up to 10% of one's portfolio to gold. In Rickards' view, gold stands out as the most durable asset, especially during challenging times. He emphasizes its role as a crucial haven for investors, even dubbing it the single most crucial haven for what lies ahead. Rickards speculates that the price per ounce of gold might rise to $14,000, underscoring its potential value in uncertain economic climates.
But this dollar shortage, which people have difficulty imagining, say, hey, the Fed printed $7 trillion. How could there be a dollar shortage? The answer is the printed money. And this is true for the Bank of England also. This is why the gilt purchases have no stimulative effect at all, because you buy the gilts from the dealers and then they take the money and give it back to the bank in the form of excess reserves. So it doesn't go into the economy. It doesn't actually do anything.
According to Jim Rickards, several notable figures in the financial industry, including Ray Dalio, have expressed concerns about an impending market drop. Rickards highlights that Dalio, along with billionaires like Paul Singer, Paul Tudor Jones, Bond King, Jeffrey Gollick, and Lord Jacob Rothschild, has invested over $400 million in the market. Additionally, financial experts such as Robert Kiyosaki and Dan Ferris have recommended investing in gold during this time. Rickards strongly advocates for individuals to consider investing in gold and maintaining a cash reserve for liquidity. He stresses the importance of having enough cash on hand to cover expenses for at least 3 to 6 months, as he believes that many people may face financial challenges in the early phases of a crisis when the market experiences a significant fall. Keeping cash readily available is seen as a protective measure against the potential storm of economic uncertainty. Recognizing the significant risks individuals face during a recession, such as job loss and unaffordable bills, Rickards emphasizes the value of a solid cash account. This financial buffer provides individuals with the confidence to navigate uncertainty more effectively, offering protection against potential financial hardships. In addition to cash and gold, Rickards introduces a unique strategy for crash protection: an investment in anti-meme stock companies. These companies, according to Rickards, represent a form of crash protection that few investors are aware of. Jim Rickards shares insights into what he considers the top 7 anti-meme stock companies for investment. These companies, with a high return on invested capital, are believed to thrive even during crises. The list includes 1. Goldman Sachs, 2. Linux International, 3. PepsiCo, 4. Rathon Technology, 5. AutoZone, 6. Freeport-McMoRan, 7. AMC Networks. Rickards suggests that these businesses' solid financial fundamentals make them resilient in turbulent times. Drawing parallels to historical strategies, he mentions that during the 1929 financial crisis, figures like Joseph Kennedy, Mark Cuban, and the creator of Monopoly, Charles Darrow, utilized similar approaches to safeguard and profit from their investments. Encouraging viewers to take action, Rickards offers assistance in setting up portfolios to navigate various economic scenarios, such as inflation, deflation, market fluctuations, or global financial crises. Subscribers are urged to click the subscribe button and activate the notification bell to stay informed with financial and market insights. Rickards promises to work with viewers to devise optimal strategies for wealth enhancement. Interested subscribers are invited to express their readiness by commenting "ready" in the comments section. Jim Rickards, with nearly 40 years of expertise, possesses a deep understanding of both the inner workings of governments, the world's elites, and the intricacies of the global financial system. With first-hand knowledge, Rickards offers a unique perspective, having observed the world from both an economist's viewpoint and as an insider in government circles. Throughout his career, he has encountered various facets, including some less favorable aspects, providing insights that may be uncomfortable but truthful. Rickards' track record includes predictions made decades ago that have materialized, showcasing a clear and verifiable proof of his foresight. His Twitter account serves as a public record of these insights. Despite acknowledging the challenges that individuals may face in the complex financial landscape, Rickards encourages taking control of one's financial destiny. In his upcoming video, he promises to reveal strategies for laying a solid financial structure and shares secrets to prevent it from collapsing. This underscores the importance of proactive financial planning and preparedness in the face of uncertainties.